current lithium prices are a lot higher. The big question is, are prices sustainable at these levels? And if they are, how much of the new projects is now brought back into viability?
Welcome back to Rockstock Channel. It is Thursday, January 15th, and I'm back with my partners Matt Fernley and Rodney Hooper for our weekly Rockstock recap. We'll keep today's discussion relatively short as we've included several lithium updates we'd encourage you to watch with Q2 Metals, Surge Battery Metals, and NOAL Lithium following this discussion. Surge Battery Metals was just on the tape this morning with an upsized $25 million deal. Previously, it was $15 million announced. We also had earlier this week a 90-minute conversation on X Spaces, which included insightful and some contrarian commentary from Andy Leyland of SC Insights, Thomas Nadrowski of Amvest's Teraden Fund, Tom Mulrich of Deutsche Rohstoff, and Chris Berry of House Mountain Partners. A replay of that Spaces will be published alongside this recap this weekend. Unfortunately, YJ Lee couldn't attend that Spaces, but I'd encourage all our listeners to watch last week's recap in which YJ articulated a very bullish lithium demand outlook. Also like to flag that earlier this week, Matt and Cormac O'Lear launched their first Recharge podcast, which digs into some similar themes we had with YJ, energy storage becoming the marginal demand driver, discipline on the supply side, and what actually matters for battery materials investors heading into this year. And Matt also published his 2026 battery materials outlook, which is available at blog.rkequity.com. Earlier today, I published on LinkedIn a quick comment on the White House fact sheet published yesterday on critical minerals processing. And what stood out to me was not just the emphasis on domestic and allied processing, but a growing recognition that price volatility itself is the root problem. We're also separately hearing credible signals that bipartisan legislation is in the works on critical minerals, and importantly, that it will also address price, not just permitting or supply chains. All of this is very much aligned with the thinking behind the Strategic Lithium Reserve, which I updated recently, reframing lithium as infrastructure where stability matters as much as volume. At the same time, the sell side is starting to reconnect with fundamentals. We saw Deutsche Bank upgrade the lithium sector, moving to a buy on Albemarle SQM and Lithium Argentina, citing tightening inventories and stronger than expected energy storage demand. And a Goldman Sachs desk note echoed many of the same dynamics. The common thread is that lithium is no longer being framed as uninvestable. It's moving back toward fundamentals. Before we go further, a quick housekeeping note and disclaimer that we will be discussing stocks today, some of which may be owned by us personally or our RK Equity clients, but we are not, of course, financial advisors, and nothing in this discussion should be considered investment advice. Please do your own research and read the disclaimer at the end of this video. I'd also like to thank our sponsors, Lithium Royalty Corp and USCF Investments. In December of last year, Lithium Royalty Corp agreed to be acquired by Altius Minerals, a diversified royalty company based out of St. John's, Canada. Altius seeks to create value via a diversified royalty asset portfolio. LRC also acquired a 1.5% gross revenue royalty on the Goulamina project in Africa that is owned and operated by Ganfeng Lithium. USCF Investments is a pioneer in commodity ETFs for nearly 20 years. Their 15 funds include single commodity exposure, broad diversification with SDCI, and themes like ZSB for battery metals and USG for gold with income. To find out more, watch our inaugural episode with their CEO, John Love, and visit uscfinvestments.com. And finally, we'd love to welcome viewer and listener input. Please let us know in the comments below any thoughts you have about the content in this episode and if there's anything you'd like us to cover in the future. And if you're watching this on YouTube, please be aware that this podcast is also available in audio form on Spotify, Apple Podcasts, and other platforms. And with that, welcome back, Rodney. Why don't you start us off with some of your macro views?
Great. Thanks, Howard. Well, I won't dig too deep into the geopolitical side of things. I'm sure everyone is aware of the sort of global tensions that are arising with Venezuela, Iran, and Greenland all in one go, all involving Donald Trump. But what we are seeing very clearly is that the world is pivoting from accepting paper and paper credit and moving to hard assets and wanting the physical. Matt flagged this a while ago on silver, and now we are seeing it. The comics and others have tried to up the margin requirements, but that's not counting anymore because what people are after is the physical. You can't put paper silver into a solar panel or into a military item. So it looks as if the world has decided that it would rather take its paper assets and buy hard assets, and that is going to have repercussions for various things. We discussed briefly last week between ourselves, apparently silver at about $134 an ounce would make the Chinese solar panel industry break even. So there is a bit of headroom, but I'll let Matt chat a little bit about copper substitution that's likely to happen. It obviously can't happen overnight. And one wonders about thrifting. There's also some new batteries coming out that have higher silver content. You've got AI, etc. So silver looks to be underpinned, and so does gold, which has now surpassed U.S. Treasuries as the largest reserve asset for sovereigns. So it looks as if sovereigns, institutions, and retail are all going for physical material. So let's see how that plays out. And of course, the US made silver a critical mineral at the end of last year. So my faith in silver, which sat flat for a while, has now shot from $30 to around $90. And I think it looks like, if you look at inventories around the world and what's happening, likely to go up a bit more. The US this year, depending on what your estimates are for budget deficits, the US has about $9 trillion of debt to roll this year, and new debt. So that's going to be an enormous strain. So if you're wondering why Jerome Powell is coming under pressure, it's pretty clear. They need rates down this year to do the rollover of that debt as cheaply as possible. I'm sure they're going to be forced to go into the short end. And Japan, high correlation between gold prices, inverted correlation between gold prices and the treasury yields on Japanese bonds and where the yen is going. So it looks like everyone is rushing to the precious metals store. And I'll leave it to Matt to discuss some of the other metals and what he's seeing in lithium. But we've certainly had a very quick turnaround. And the question now, I guess, is there front loading in lithium demand and where do we go to from here? Matt.
Rod, before we sort of get on to some of the other metals, maybe, could I just ask you how much of the move that we've seen really across the commodities complex over the last sort of 4 or 5 months, how much do you think is down to the weakening of the US dollar?
Well, actually, the dollar in the last 6 months is up. So the DXY is actually nearly at 100, but that might just be global uncertainty and the sort of regional emerging markets pivoting and putting their money with the dollar because it looks like Trump is doing his thing. But I think what it definitely is a shift from is people are not being prepared to earn 3 or 4% on long-term bonds of 10 and 30 years and to be paid back in dollars, because over the 10 and 30-year time, considering the budget deficits that the US and Japan and France and a lot of others are running, the only way out is print. So, I think, you're going to get your coupons. What's your 100 going to be worth when you get that back in 10 or 20 or 30 years is the concern. So that has been an outright shift, and a lot of the traditional holders, out of the BRICS side of it and elsewhere, have turned their backs and have decided to buy the physical metals rather than bonds. So that's been the big shift. And there's talk that actually sovereigns have been using banks rather than doing it directly themselves. So they've been quietly accumulating. And it's probably a smart idea. The more your hard assets back up, what you've got issued out in the economy, probably the more likely, you won't have a run on your currency.
I mean, I'm interested that your view on that. I guess I should have been more specific. The US dollar against commodity currencies, because commodity currencies have almost all strengthened against the US dollar. But it's interesting that your point that the DXY has actually weakened while the commodity currencies have strengthened against the dollar.
Yeah, I mean, in the last 6 months, though, the DXY is actually stronger.
Right.
So over a year, it's weaker.
Yeah.
It's down by the 9-10%, and that has always historically been the case. And, Howard maybe can interject here, but if Trump and the administration is serious about bringing manufacturing home, you do need a weaker dollar to compete globally.
I don't know if I have a comment on that specifically, but it's interesting you mentioned, Matt, that the commodity currencies are stronger now. They were weaker when the DXY was stronger, right? So you're seeing that's an interesting dichotomy, and that actually improves returns. If you're invested in Australian or Canadian dollar stocks, right?
I mean, if you look at, for instance, you look at the Aussie dollar, the Chilean peso, whatever, over the last sort of 4 or 5 months, they've strengthened quite considerably against the US dollar, which is great news for commodity prices, because that obviously is putting local currency costs up, or sort of US dollar costs up, which is always a self-fulfilling prophecy. But I'm just interested to hear from a macro point of view. But that is a very interesting point of view, that other currencies are not strengthening against the US dollar, consumer currencies.
Well, investments happening in those countries, right, for critical materials. So inflows of capital, into local markets, will appreciate those currencies. So
but
I think
that's... I mean, if you look at the Rand and what have you, the Rand is up 20% roughly, or 18% since March. But if you look at the export value of the commodities that they produce and the critical minerals they produce, there might be some investment, but a lot of it is just export balance is looking good because they are getting far more for their output.
I mean, this is something that we always see sort of into a strong commodity cycle, that we tend to see the commodity currencies strengthening against the dollar. And that obviously then puts pressure on the US dollar cost curve. And there's a sort of self-fulfilling prophecy, causing sort of US dollar denominated commodity prices to increase. But again, it's sort of making the point that what we're seeing at the moment is a broad-based commodity cycle, not necessarily commodity-specific moves in the same way, which comes back to many of the points that we talked about on a recap over the course of last year. Okay. I mean, I think that, I could talk about any one of a number of commodities out there. I guess I really want to talk about lithium. It's been a really, really strong commodity over the last sort of 4 or 5 months or so. And I think what's very interesting now is, middle of last year, back end of last year, we saw all those sell side upgrades. I think current lithium prices are a lot higher than most of those sell side upgrades were for 26 as a whole. And the big question now, from my point of view, is, are prices sustainable at these levels? And if they are, how much of the new projects, the incentive curve, as it will, is now brought back into viability at these prices. So, a lot of the projects that were effectively, the development projects that were effectively shelved over the last 2-3 years because lithium prices were so low are back into viability at these prices. And I can't remember who it was on the Spaces conversation the other day made a very important point that a lot of these feasibility studies have been let go basically over the last 12 to 18 months. So they're going to need to be updated at current prices. But it's going to be very, very interesting to see that a lot of these development projects that have been basically pushed out could come very much back into vogue at these current lithium prices. So that was my main takeaway from the Spaces, and also from where lithium prices are at the current time.
I think that was Andy Leyland of SE Insights who had that insight, and he had actually several other insights. He listed 5, and I'd encourage you all to listen to that Spaces to hear that in detail. But what he did say is that he didn't have to upgrade his forecasts like the way the sell side has, because he already had relatively high price forecast. That said, his forecast for 2026 was $19,000, right? And we're quite a bit above that. But he did think, I think I heard him say that he saw 2027 prices, in the 40s, averaging in the 40s next year. So that's a doubling, from here. And Matt, you said after the Spaces, we were talking yesterday, I think, don't want to put words in your mouth, but you thought that lithium prices could be averaging in the mid-20s, this year.
Yeah, I mean, I think there's lots of unknowables, in the lithium price at the moment. Do I think it's sort of near-term overshot? I think there's a possibility that it's near-term overshot. But looking at the supply-demand balance, looking at my updated supply-demand balance, which is now in deficit for the next couple of years, there's every potential that the lithium price could continue to rise from here in average terms. So yeah, I think, near term, a little bit AC/DC, but in the medium term, I'm certainly more constructive on lithium than I have been for a while.
Okay, great. And I do want to flag as well, we did mention this in the X Spaces, that Deutsche Bank last week came out, later than some of the other investment banks with those upgrades of Albemarle, Lithium Argentina, and SQM. The title there was "Buckle Up, We Are Becoming More Bullish." And then yesterday they had an update for this, and they said the most dangerous words, I think, ever that anyone could ever say in any kind of financial market is "this time it's different."
I have said that a few times in my career, and each time it's come around to bite me on the arse. So,
well, I'll flash up.
Maybe it's a young analyst.
I'll flash up some of the reasons here. It says, how is this time different? It's a more established market, expanded market size, enhanced financial instruments, China's role in the market, best demand, and sideline capacity, et cetera. I haven't actually been able to read all of this in detail, but I just wanted to make that comment. When I saw that headline, I thought it was pretty dangerous. But anyhow, it is reflective. And I mentioned this. I participated in a panel, as I do every year, at Deutsche Bank's conference, I think like in November, and Corinne Blanchard, who moderated that, mentioned then that she still wasn't seeing very much investor interest, and they service, very significantly hedge funds in New York, and Boston, et cetera. But there wasn't that much interest. So a month later, 6 weeks later, to hear from her and her team that they're now actually seeing that interest, was telling for me. All right. What else should we talk about, guys?
Well, I think we should probably talk about a little bit about the AEM podcast that we had on earlier last week. AEM, for those people who haven't come across the company before, is a HPA developer, high purity alumina. High purity alumina is a fascinating material that I've been tracking for a number of years, which is exposed to high tech applications in the semiconductor and the battery sector, and its applications are growing all the time. It's a very, very small, very consolidated market. These guys are a new producer in the market. They have a production asset in Quebec in Canada, and it's a very interesting story, and how it actually equated the HPA market with the lithium market 8 or 9 years ago, and I think that's a really interesting comparison. And I would advise people to have a look at that podcast because it's a very, very interesting material, and I think it's going to be of increasing importance as we move into what is going to be a very major sort of high tech boom, probably over the next 5 to 10 years.
The corollary I saw is that the market size is somewhat similar to what lithium was at $1 billion, 10 years ago. And Richard Seville, who's the chairman, was the founder of Orocobre and led that to a very successful trajectory over 10 years, from sub 15 million market cap to multi-billion-dollar merger. So anyhow, we like that story, and it requires a lot of explaining, like lithium did 10 years ago, and where we are an advisor to the company, and we encourage all of our viewers, as we have with Cesium and Power Metals and Seafloor Mining and the Metals Company, and to some degree, Hyperion X and titanium, and also as well phosphate, First Phosphate. These are niche materials. We are in a market environment like this White House fact sheet yesterday. It's focusing on processing, not just like upstream, kind of bulk commodity coal or iron ore. They understand high purity processing is the choke point of a lot of specialty materials. So things like high purity alumina and phosphoric acid are not super well known, as like kind of lithium and rare earths have increasingly become, but it's exciting times for very niche materials. And as you said, I think in your outlook, it's more fundamentals than hype or reality versus hype. Matt, like last year, you had a lot of stocks go up. There's a lot of not such great projects out there, a lot of misunderstanding, misinformation, disinformation. But now this is a year, and in the next few years, where really understanding these materials is critically important, but also it can be a source of gigantic returns and generational wealth opportunities if you identify the right winners. And we've been doing that, not always successfully, but for the most part, for 23 years as RK Equity, and look forward.
I mean, for me, identifying the right material is as important as identifying the right company. So if you can identify, a material that's going to take off, and then you find interesting companies within that material, you have a really good opportunity to, make very large investment returns. And increasingly, I feel that there's a number of materials out there that aren't very well known to investors that are going to be really, really important going forward over the next 5 to 10 years. And they potentially will be, accessible to retail investors and small investors before they're going to be accessible to institutional investors. So, early on in the evolution development of those materials, potentially there is potential for high returns for early movers into those, niche materials.
One not so niche material that you flagged late last year, so thank you for that, was aluminum, right? And bauxite. There are some stories that we're involved with, like Brazil Rare Earths, that have interesting bauxite projects that are not necessarily being valued, by the market. And I think rare earths will continue to be interesting, and this dichotomy of heavy versus light rare earths. I think DYTB is going to come into focus more than just NdPr and things like yttrium and a few others. But anyhow, we're available. Matt and Rodney and me will be bringing all of this to you. If any of our viewers or listeners have ideas of specific companies or commodities that you think deserve more airtime here on Rockstock Channel, again, please let us know in the comments below, or email us at rockstockchannel@rkequity.com. Okay, we may or may not have a recap next week because I am traveling on vacation for the first time in a long time to Costa Rica, but we have recorded a few other videos, including First Phosphate, and again, that Spaces I mentioned. And if I'm forgetting, there may be one or two others that we recorded that will be published next week. So look forward to sharing all of those with you, and I'll see you back toward the end of this month.
Alicia, Happy New Year and great year 2025 for Q2 Metals. Wondering what you have in store for us in the first half of 2026.
Yeah, Happy New Year to you guys. First half of 2026 is going to be busy for us. We are currently mobilizing to site, and we've got some crews starting up. I don't even know what day it is today. So they're starting up, I think is Thursday, Friday. They're having their sort of kickoff meetings, and then we'll be drilling as of this weekend. So when we left at the end of December or middle of December, we had 2 drill holes collared at that point. So they'll be starting those holes up. And then they've got the other 2 positions. So they'll be ready to go with 4 rigs going again. And that's anticipating drilling straight through until April 20th, around there, when we have to stop for goose break. So, and then we have our MRE coming up. So our maiden mineral resource estimate is, we're hoping to get that out by the end of February. So right before PDAC is the goal. So it's been busy around here getting all the little bits together.
Okay, great. That sounds great. I think that obviously, based on the exploration target, this is a world-class asset. So it's going to be great to see the maiden resource, and hopefully you'll have good numbers for us, and it'll put us squarely on the list of largest projects in the world.
Yeah, let's hope.
What I'll say is that I'd encourage all our viewers to listen to the Spaces we did today, which included a comment from Tom Woolrich, who has recently shared his model on Rockstock Channel based on the drill results as of a few months ago. But he was telegraphing a very significant deposit, and was also talking about, this cycle, he's having more concentrated bets rather than, owning too many lithium stocks. So he always compares any other company to this one, and he just keeps coming back to Q2 at a US 300 million market cap. He said it compares, to Pilgangoora at Pilbara, a 10 billion market cap. You could see still a wide gap. So the tailwind is behind us with the lithium price. Q2 started last year around 65 cents. I think we interviewed you at the roundup, Alicia, that you had a bunch of warrants being exercised at that time. And then, as Matt said in the Recharge podcast, it was a tale of 2 halves last year. Had you bought the bottom of Q2 somewhere in the 40s, in May of last year, you'd be up 5 times. But it's not too late, because this is still early stage Lassonde curve exploration in a market environment where the price is now hitting incentive price levels very, very quickly. Within a month or 6 weeks, the lithium price has risen a lot. So great to see you, Alicia. It's a very happy time. And a maiden resource mid-February into PDAC. It's going to be an exciting first half.
Yeah, for sure. Look forward to seeing you guys.
Okay, Graham, we're just starting out the year here, and we're asking a couple of our clients, what's in store in the next 6 months and 12 months of the year, and why should our viewers buy Surge battery material stock?
Hey, thanks, Howard. Santa Claus came at Christmas and delivered a huge increase in the lithium price, and that's translated to a big increase in awareness in our sector. Again, has been in the doldrums for a couple of years, as you well know. As far as Surge battery metals, we've been talking about it for a few years. I truly believe that Surge battery metals has the best lithium deposit in the US of A. I think the focus now on critical minerals, your white paper states the same case, is all about securing domestic assets, domestic critical minerals. And I think we have one of the best lithium deposits. So I think there's a lot going on. There's a lot of momentum behind us, and we will continue to deliver on the project. And as far as that goes, this year, we're working on the PFS, and that's going to be a big milestone for us. We'll be announcing shortly hiring the engineering firm, and we have a lot of work ahead to de-risk this project. And as we continue to do that, it will continue to stand head and shoulders above all others.
Graham, it seems that others agree. You've had an announcement recently on your site about an increased stake position in the Courtenay Group.
Yeah, they're very good shareholders. They stood by us through thick and thin. They financed us earlier this year when nobody else wanted to step up to the plate. They've continued to support us in the markets. They're an interesting group. They're well backed, well funded. They've had a lot of success with a previous company I was a director of, Millennial Potash. They're doing quite well there, and they're supporting us in the market and working up their stake. I think they just got up to around 8%, around 12% fully diluted, and they see the opportunity. He approached me about a year ago and looked at the PEA when we published it and did an analysis and decided, through his modeling that this, the stock price at the time represented less than a 10% optionality on the lithium price, notwithstanding the project itself. It was just tied to the lithium price. And, he's one of those people like a Warren Buffett who searches for opportunities, and a very smart individual, and thrilled to have him as a major shareholder.
And Graham, just also, if you could reconfirm, you did your original PEA, it came in at a little over 9 billion. The implied pricing on that calc was, remind me, the long-term pricing?
We used 24,000.
So not far from where spot is now.
Correct. So that was benchmarks analysis. That's the one we used at the time. We also used it because that's the same price that our peers were using. So when people wanted to compare apples to apples, then, we use the same price as LAC and Lithium Americas, and all the recent PEAs that we could get our hands on we're all using 24,000. So yeah, it's fortuitous at the time. We do think that's fairly reflective of the long-term price. When we published it, of course, the price was a lot less, and people, what happens to this? But there is a sensitivity analysis in the PEA. So you can see what the sensitivity is to, 15,000 a ton, 20,000 a ton, 25,000 a ton. So that's, pretty accurate for where we are right now. And when we get to the PFS, I'm pretty sure it's probably going to be the same price.
Okay, Graham. Well, I'm looking at the 1-year chart, and you started at 35 cents last year, and then you were at 25 cents by September, and you've made all of that up and a hell of a lot more. For those picking bottoms, we joked, sometimes you get smelly fingers, but in this case, you're coming up roses. Up 4 times from the low in September. So may that continue. 192 million Canadian market cap. Arc Equity is an advisor to and invested in Surge, and very excited to see the stock. I think is it all-time high? Yeah, it might be near all-time highs. So Graham, hats off to you, and look forward to following the story throughout 2026.
Well, thanks to your team. You introduced this to your investors at 25 cents. I hope they're all had a great Christmas, and look forward to a great new year. I think we're going to have a great year.
Hey, Gabriel, Happy New Year, 2026. Hopefully, a really good year for the lithium market.
Yeah.
So, just a quick couple of questions for you. Can you let us know what are the catalysts for NOAA Lithium in the first half of 2026?
I would say that our main targets for this year are to get the PFS for Rio Grande before the end of the year. So we're going to start some preliminary activities to support the PFS during the first half. And the same thing, we want to start unlocking value for one of our secondary projects. We got, besides Rio Grande, we got two other projects, Salinas Grandes and Arizaro. And we wanted to start unlocking value for Salinas Grandes. So it is likely that we're going to start doing some geophysical work in Salinas Grandes that will supplement the information we already got in Salinas Grandes, that will provide additional information to start a small drilling campaign there. We are very confident that Salinas Grandes may be a very high potential project going forward. So I would say that these are the two good catalysts.
Those are the main catalysts. Okay, great. And obviously with lithium prices going up, investors are going, well, which stock should I buy? If you're talking to investors, why should people buy NOAA Lithium at this point in time?
I would say that we consider ourselves well undervalued in comparison with our peers. Our current market cap is $50 million US. If we compare with just one of them, Lithium Chile, that is current market cap is close to 100 million US, but recently they are negotiating an acquisition for its Arizaro project for 180 million for 80% of the project. So we are talking about 4 times our Rio Grande, our market cap. So we are well undervalued with an asset that we believe that Rio Grande is higher grade, a little bit larger resource. It's not dependent on DLE. So we believe that we got a very high potential of growth in terms of our share price. The other advantage that we got in NOAA, as mentioned before, is not just Rio Grande. We got 2 other assets that we can unlock value and potentially add value to our share price and the company. And so we believe that we got a lot of potential that is still there and haven't been materialized, and the market haven't seen that yet. So we need to create more awareness on that.
Well, we're doing our best to create awareness, Gabriel. Over the past year, we were talking, Matt in his blog talked about a tale of 2 halves last year. And with you, it was a tale of 2 halves, but you are outperforming the market, for the first 3 quarters of the year. And you were up, I don't know, we were talking about it. You were up 50, 60% when most other lithium stocks were down, and here we are, looking at your chart, which we can call up here. You're 10% down on the price you started about a year ago. And the backdrop is so much more positive. Lithium Argentina has rallied aggressively. Galan has rallied aggressively. Lake Resources has rallied aggressively. And here you are, people are wondering now, a lot of things have gone up. Like what hasn't gone up that's high quality, that should go up. And, sometimes you do a financing. You did the $5 million financing late last year. In my observation, how it traded after that was a bit sloppy, from an underwriting perspective. It takes some time to kind of absorb that. So I think I've been buying some additional shares myself in NOAA. recently. And if you believe in YJ Lee's forecasts for 500,000 tons of additional demand this year, or even if it's a bit less than that, and with carbonate to LFP being very much, in theme here. And if you listen to our spaces earlier this week, lots of talk about mid-20s price for lithium. No one was talking about that 3-4 weeks ago, right? Like people were like, well, maybe it'll be 15. So all of those who have put together PEAs and PFSs with low 20s, prices that demonstrate, good returns, that those don't look unrealistic at all. So bottom line, exciting time to be back in the lithium space. We'll remind all our viewers that some of the biggest M&A has happened in Argentina. Obviously, Rio Arcadium, but there was many, many more acquisitions that were in the 300, 500 billion plus, range. So a conventional brine, high grade, doesn't need DLE, trading at 50 million US market cap. Do your own research, but looks pretty cheap to me. All right. It's going to be a happy 2026, Gabriel. Look forward to following the story and interviewing you again soon.
Yeah, okay. Thanks, Howard. Thanks, Matt.
And before I sign off, I'd just like to thank again our sponsor, USCF Investment, who've been making it easier to get exposure to commodity investments for almost 20 years. USCF's Sustainable Battery Metal Strategy Fund, ZSB, is designed to capture investment exposure to metals powering electrification, such as lithium, cobalt, copper, nickel, aluminum, and silver. To learn more, watch our inaugural episode with CEO John Love and visit uscfinvestments.com. And thanks as well to Lithium Royalty Corp, which published their Q3 results, which demonstrated 86% growth in revenue from last year's third quarter, which included a first royalty payment from their 3Q project operated by Zijin Mining in Argentina. To read that press release, visit their website, lithiumroyaltycorp.com, and follow them on X at lithium_royalty.